Hey everybody, welcome to a new episode of Blockchain Central. In today's episode, we're going to talk about something that is called both the next big thing in blockchain and the end of blockchain as we know it. What's that? STOs, or security token offerings, are on the agenda today. First of all, let's see what STOs are and how they differ from ICOs, or initial coin offerings. If you need a refresher on what ICOs are, check out this video. The main difference is reflected in the name. Security token offerings, as the name suggests, offer securities to the buyers, while ICOs focus on making coins available to them. If I was to summarize the difference in one sentence, I'd say that if you participate in an STO, you become a partner in the business as an interest holder, whereas with an ICO, you become invested in the success of the coin itself. It is sometimes said that STOs hold intrinsic value and they can guarantee interest, profit sharing, dividends, and voting rights, etc. You might argue that ICOs are also a form of a security, as they are an investment in a common enterprise with the expectation of profit. Many ICO teams, however, were proactively trying to avoid being classified as a security to avoid a long list of requirements imposed by the SEC. This has been an ongoing discussion whether ICOs should be considered securities, and the primary tool for determining it is the so-called Howey test. The purpose of this test is to determine whether something should be classified as a security, even if it is offered under a different name to avoid regulatory actions. The primary question that we should be asking ourselves when performing the Howey test is whether the profits we mentioned before are expected to come solely from the work of others, that is, the enterprise we invested in. When it comes to coins, their success depends not only on the hard work of the issuer, but also on the market sentiment and the behavior of other buyers, which led many not to classify ICOs as securities. As of right now, in early 2019, we clearly see that such a complete lack of regulatory oversight has not worked well for the industry, with multiple ICO scams present in the past 2 years. STOs, on the other hand, do not shy away from complying with SEC requirements and embrace the regulatory oversight. In fact, the drive to comply with legal requirements might be a defining factor of an STO as opposed to an ICO. The level of oversight can also help us classify STOs into 3 different categories: Reg D, Reg A+, and Reg CF. Regulation D, or Reg D, is an SEC regulation governing private placement exemptions and can be a way for smaller companies to accumulate capital without the cost and hassle of an initial public offering. The rules are still relatively strict, requiring the enterprise to provide proper framework and disclosure documentation, including names and addresses of their executives, as well as details regarding the offering. Under Reg D, the issuer of the securities must also disclose any prior bad actor events. Although not aimed exclusively at accredited investors, Reg D guidelines strongly favor those over unaccredited ones, which can slightly raise barrier to entry. The second category, Regulation A+, or Reg A+, which is usually referred to as the best pathway to STOs, allows the enterprise to annually sell up to $50 million worth of securities to the general public. In return, the issuer has to submit audited financial statements in their offering documents and file reports with the SEC on an ongoing basis. Regulation CF, which stands for crowdfunding, limits the annual amount of money that can be collected to $1,070,000 and requires the auction to take place online through an SEC-registered intermediary, such as a broker-dealer or a funding portal. It is clear that the big crypto players have already been looking at STOs for some time. Coinbase, the largest Bitcoin exchange in the US, acquired Keystone Capital, a financial services firm, in June of 2018, therefore becoming a fully regulated broker-dealer. We can already see that STOs will be significantly more regulated and hopefully safer than ICOs, but for now, we have to answer a fundamental question. What's the point? Why even bother bringing securities to the blockchain? As always, the answer is the democratization of the investment process, allowing investments to happen across borders and removing gatekeepers who prevent individual, low-tier investors from participating in the market. A blockchain-based security can hold all relevant asset information, such as capitalization tables, dividend payments, voting rights, or liquidation preferences. Each participant will know at any time what their stake is and how much it is worth. This information, as it is integrated with blockchain, will be secure and immutable. And when we bring smart contracts into the picture, it could potentially also help automate necessary parameters, for example, pertaining to the restricted stocks. Another strong draw for the STOs could be the liquidity of security tokens. Whereas investing in a startup would usually require a 5 to 10 year exit period, security tokens promise near-term liquidity on exchanges that will trade tokens 24/7 and attract a global pool of investors. Also, if you factor in the possibility to infinitely divide an asset, it could open opportunities for a completely new class of trust funds and asset portfolios. There are, of course, many risks associated with the new asset class. Some people question the existence of a secondary market for security tokens. Others are afraid of a new batch of bad actors riding the hype train into riches. Many exchange platforms are looking into expanding their operation by including security tokens in their offer. But as of early 2019, no mainstream platform has provided such services. Also, it is understood that a truly decentralized stock exchange would require both the issuer and the purchasing party to comply with the international regulations if it is to operate across borders. This would make it almost impossible for any single exchange to service clients on a global scale in an STO market. Keeping up with each country's individual exchange laws would be cumbersome, costly, and effectively render universal security tokens impossible. But by far, the biggest concerns voiced by the crypto community have to do with the fear that this STO movement is a way for the old school finance world to take back some level of control in the financial realm. They are worried that the increase in regulation oversight will counteract the decentralization and democratization of the market. We'll see what the future will hold, but we remain cautiously optimistic. It's just important to remember that the compliance requirements of the STOs are here to protect you against a scam and not bad investment. So always do your due diligence when purchasing assets. Before you go, please note that this content does neither represent financial, legal, or tax advice, nor is it supposed to be understood or interpreted as solicitation to buy or sell any securities, coins, or tokens. Thank you for watching. If you like this video, make sure to hit the like button and don't forget to subscribe to Blockchain Central to never miss a beat. See you in the next one.